Hello there and welcome to the fourth part of the course, and in this video we're going to take a deeper look into the financials, so the fundamentals of the business through the three main financial statements. I hope that you took my advice and in this process you're valuing a company on your own. That doesn't mean that watching this video will answer all the questions that you have for the company that you're valuing, but at least it will raise some questions that you can figure out how to answer on your own. Of course, with the help of Google, and if that's not sufficient, then you can always drop a question in the comment section below. Now, what we've done so far is, of course, we've taken a little bit of a kind of a quick look at the financials of the profitability. We filled the template and we could see that Nike, for example, grew 6.4% year over year. Now we know that inflation wasn't high, so this growth wasn't really due to inflation, but it's still not clear what caused it. Was it organic growth, or was it maybe that because they acquired some company? That could also be the case. So there are still some questions that we have to ask. Then if we take a look at the operating part of operating expenses, this segment is a little bit not optimized, as it grows faster than the revenue, and that's not something that makes sense in the long run. And the way you can take a look at it is, of course, what I suggest is first start with vertical analysis. And what that means is just take 1 year and just look at that column and try to understand that individual year. So try to understand the profitability. If you're looking at the balance sheet, try to understand the balance sheet for that particular year. Of course, the most recent one makes most sense. Then once you're familiar, you can go and look into the horizontal analysis, or how it developed over time. Now, when you have more experience, then you can do both kind of almost at the same time. And I'll try to stick with what I've just mentioned to do the vertical part and then the horizontal, but I might jump left and right in those approaches. So we're going to take a look into that, just kind of a short introduction to this video, and I hope that you enjoy it. There are quite some questions that I've noted, or actually not that many for this particular company in the previous videos. We might try to answer those as well as part of this one. I'll try to keep it short, but I can't promise that, as you already know based on the length of the previous videos. Now I have something to drink with me. I have a cola. Make sure that you're comfortable when performing an exercise like this. Don't make sure that the environment around you is one where you feel relaxed, and this process is more enjoyable that way. Otherwise, of course, you'll see it as a not an enjoyable activity, and that's not the goal. In this process, you can use a third party, some sort of a tool such as Ticker. I also have that here as well. I'll leave a link in the description. I'm sure that many of you are familiar with this software. It's in my opinion, very well done. It doesn't mean that all of the data are always correct, so you sometimes need to double check and to always refer back to the annual report in case of questions. So we're going to take a look at that as well. As you can see, I have some locks here, so I don't have the paid version. For me personally, it doesn't add that much value, but if it does for you, feel free to go for it. And of course, not only the income statement, we will look into the balance sheet and cash flow statement as well. So for the income statement, we have some data here as well. What I want to start with is this first part, the gross margin. Normally, what we have here is, of course, the company, in this case Nike, sells products, footwear and apparel, and we can see the total value of the products sold, so the revenue that they've earned through selling these products. And this is what's left for them after covering the costs of the products. So their margin did improve a little bit over time. And if you see a company where the gross margin decreases significantly over time, so I'm not talking about a decrease of 1%, but if it's a significant decrease, it means that they don't have pricing power. So, for example, in the case of Nike, right, they have a cost of manufacturing, or whether it's in-house or, as we saw, it's outsourced, of for example, a pair of shoe. And let's try to simplify it, 46%. So let's assume that it cost them $54 to make one pair of shoes, and then they sell it for $100, right? $100. So what we have in that case is, let me try to do it like this. What we have in that case is gross profit of 46 or 46%, right? So that is what we have in the most recent year. And I'm simplifying this, but I just want to show a simple point. Now, if this cost, right? So this, in this case, it's cost of product. If you have a service, that would be cost of service. If the cost of the underlying product increases by 10% or 15% because of inflation, for example, as we're going through now, if it goes to 60, right, then for Nike to have the same margin, right, this needs to represent 54% of the final price, right? So in that case, we can just simply divide by 54%. So they would have to raise the price from $100 for a pair of shoes, for example, to 111. And when they do that, right, then this is the gross profit. And you'll see that, of course, they have higher gross profit, but the margin remains the same, right? 46%. So this is important because if they cannot raise the prices, right? If they have maybe the demand will not follow that, then that's what happens to the share, to the gross profit, to the gross margin. So gross margin is a simple indicator of whether a certain company has pricing power, and that can be exactly at this point when we have inflation, a very useful, simple indicator to look at. So for example, for Nike, it might be also a little bit too early to make that conclusion, but I think it's fairly, I think it's a good conclusion that they do have pricing power, as the demand for their products, as it's still a high quality brand, is quite inelastic. So this part, of course, the costs of the goods sold increase as more products are being sold. The part below is normally referred to as fixed costs. For example, if we take a look at general costs for their accounting team or legal team or HR, well, it doesn't matter how many pairs of shoes they sell, they still need to cover those expenses. So those are not tied to the sales that they have. So in a nutshell, I mean, there are a couple of points that we can look at. This is definitely one important, and then of course the other expenses as well and how they develop over time. I'm not very happy with this part, that in general, that if we take those two together, we have 31.6%. You probably cannot see it from the camera, but now it's actually like almost the same. So there isn't really improvement. And when a company grows, at some point we expect that these operating expenses decrease as percentage of sales. So for Nike, we don't have really sufficient data to establish a trend that actually they are decreasing over time. This one, the marketing and sales is, but the second part isn't. So if we take the two together, actually it's flat as a percentage of revenue. Now, on the right side here, we did extract some information, some both operating information about the business, but also the non-operating assets. That is important for the model itself, but that doesn't provide us enough information of the development of the balance sheet over time. So what I'm going to do is I'll move to Ticker, and we're going to take a look at the balance sheet. Let me see if I can zoom in a little bit more. Hopefully this is a little bit better. So we can see where the company is today, right? If we take a look at the latest numbers and make sure that you have the latest. So sometimes you have to add the column LTM, so the last 12 months. In this case, the last 12 months is the same as the year end. So I've hidden it for that purpose, but just be careful that sometimes you need to look at the last column, and sometimes it's the column before is exactly the same. So if we're looking at vertical analysis, if we take a look at where the company is today, then we're only focused on this one column, right? So this is all that we're interested in. We can see that the total balance sheet is 40.3 billion, right? Out of that, we have 12, almost 13 billion in cash and short-term investments. Now, short-term investments on its own is not that descriptive. So the best way to understand what that means is go back to the annual report, and of course in the balance sheet you should find something similar, right? Short-term investments. And where do we find more information around that? It's all in the notes. So if you scroll a bit below, by the way, maybe I should Move a little bit back. I am in the financial statements and supplementary data section. And then at the end, of course, we have the notes. So sometimes, as mentioned, there's this table of contents. Not always. We know that we're not interested at the moment in inventories, PP. So probably what we're looking for is in the fair value measurements. I know that it's not self-explanatory in this case, but if you go through a couple of annual reports, then that makes more sense. So let's take a look at page 69. So I'll scroll a little bit below. Here's fair value measurement, and one of the columns is short-term investments, 4.4 billion, and we can see that they have significant amount in US Treasury securities. So those are, again, less risky securities and are fairly easy and quickly convertible to cash. Same goes for the commercial papers and bonds. So both of these are, I'd say, a temporary place where they place all the excess cash that they don't intend to put in use. So if we go back to the overview, we can see that in the 13 billion, I would even put it in the same bucket as cash and equivalents. Even though it is a separate instrument, it's easily convertible to cash. Accounts receivable, there's a simple description here, but it's pretty much all the amounts that customers owe to Nike, and they'll collect them in the next period. So it could be 30, 60, 90 days. Then we have inventory, of course. How important it is. It is definitely important for Nike to have inventory, and we can see the percentage of these items as percentage of the total assets. So you'll notice that 28 out of 40 billion are already only the cash and receivables and inventory. These are a bit lower amounts, and of course, goodwill, other intangibles. Sometimes if you see something that's not that material, you don't have to spend too much time on that. And now, for example, that's on the asset side, and you can do this kind of a similar exercise on the liabilities and equity. But this is important to understand the balance sheet as the structure of the balance sheet and to understand what's on there. But to really get better insights into how the company developed, you need a couple of years. So let's take a look at the last 5 years, right? So it's quite clear that Nike always had quite a lot of cash, but in the most recent years, it's way more than what it used to be, right? Having excess cash isn't, of course, bad necessarily if they're about to put it in good use, but if it's there on the balance sheet for a couple of years, now we see it for 2 years, it's not creating value for the shareholders, and even it might be even better just to pay them back as either a special dividend or buyback shares. So having 13 billion, which is, I'd argue a significant amount, not being in use, it's not producing a lot. The short-term investments, a couple of percents a year, that's really not much. So I would like to see Nike put these into use and not have them on the balance sheet, just having, maybe it's just for extra security, but this is really a high amount. Now, next is accounts receivable. So they went from 3.5 billion to 4.7. Normally, there is a percentage of revenue that will be still outstanding to be collected as cash. So what I want to check is how good is this process, the accounts receivable process. As a simple check, what we could do is, here in the additional info, I'll scroll down. So I'll check this. Accounts receivable, the amount that they had in 2018 and 2022, right? So at the end of both years, fiscal years. So they have 3,498, so close to 3.5 billion. And what I have now is 4,667. So we have an increase of 33%. So my question is, did the revenue grow by as much, right? So we already have the numbers. I'll copy these here. The revenue grew 28%. So the accounts receivable management wasn't as good, didn't follow this pattern. So again, from an operating point of view, you want to collect the cash as soon as possible. We could also do some some simple accounting ratios. There's, for example, the days outstanding and all of that when you have these two numbers. So what I'm also curious is, knowing this, what about the inventory? Because inventory, right, this is one significant part, but then there's also inventory. So they had 5.2. I'm going to add that here as well. So sometimes it's a bit of a messy process, but I'm trying to get some insights. And it's the first time that I go through this data, and I know that it might be a bit messy, but stick with me. And if you have questions, feel free to reach out. So what we have is 5.2 billion in inventory, growing to 8.4 billion. So we have an increase of 60% of the inventory balance. And this is not great. This is not great. So if I'm valuing this company and I'm creating a video for you as a casual valuation, this would be one point that I'll note, because 60% increase is, in my opinion, a bit more than I would expect. Because if you take a look at the cost of goods sold, right? Because inventory, when it's being sold, it moves to here. We got 20 billion and it grew to 25,231. So that is a big difference, because we have an increase 24%. Of course, it's more accurate to take the cost of goods sold instead of revenue, as inventory then moves to cost of goods sold, not to revenue. Revenues, of course, if we have expansion of the gross profit, which we have here, we see the difference as well. So one of the points that I'll note is cost of goods sold. Inventory has increased significantly. And why is this an issue? Because similar to the short-term investments above, both of these are, there's capital tied that is not being put in use. So the better the company is in terms of inventory and accounts receivable management, those numbers would be lower compared to, again, whether it's revenue or cost of goods sold. This one isn't that significant, $1 billion, same for this one. PB, yeah, we had here the lease recognition standard, so that increase is also logical. Yeah, not really something that's way too significant. And on the liabilities, I would note that there is quite a significant increase here in the long-term debt. So that is something that it doesn't seem that they really needed it, but probably around 2020, so probably around COVID, it's maybe they actually, we saw that also in the annual report, that it's relatively cheap debt. So I don't think that's actually necessarily bad, and it's quite balanced, because it's 9-10 billion isn't really that much compared to the market cap. Because what was the market cap if we go back? 100 and something billion, 152.2 billion. So having 8% is debt, so it's not much. So I wouldn't say that the debt management is bad, and also they managed to increase that at good rate. So that's quite all right. The number of shares outstanding did decrease over the last 5 years, so there's probably a lot of share buybacks that we should be able to find also on the cash flow statement. So this is kind of a short analysis on what I would do when looking at the balance sheet. I would go line by line, try to understand the ones that are more relevant for the business. So if there's a company that is in a service provider, then you won't see a lot on the balance sheet, because there won't be inventory. The accounts receivable should be also quite comparable, but there won't be that much maybe property, plant and equipment. There's no manufacturing. And when there's long-term investment, for example, I mean, the process is similar. You can always find it in the annual report. Sometimes it could be that they own shares in another company. Sometimes, I mean, I'll give you an example. If I think it would be as part of intangible assets. If a company, for example, if Nike owned Bitcoin, I'm not sure if I would value it based on what's on the balance sheet. So as part of the template, I wouldn't fill all of it, for example, in wherever it is. Like maybe it's probably in the other non-operating assets that I would fill. Because if I don't think the value is as much, same goes for the deferred tax as explained in the previous video. There are some adjustments that we can make, and we shouldn't take everything for granted that we see on the balance sheet or pretty much anywhere else. Of course, the accounting standards are set in such a way that they protect the readers as much as possible, but they're not perfect, and there's a lot of things that can go wrong. And since the annual report is published at a certain point of time, there's something that can change in the meantime. And if you're looking at something such as Bitcoin, then there's a lot of volatility as well. Now, the last thing that I'd like to cover, and I don't want again to make this video very long, is the cash flow statement. You can take a look at this. I prefer to take a look at the one published from the company itself. Let's see if we have for a couple of years. Yeah. So the cash flow statement, I haven't made a separate video on this. Maybe I will at some point if that's needed. It's divided in three categories. The first one is cash by operations, and you'll see this is the total sum. That is the cash that the company generated purely through its operations. So for Nike, that is selling products and services, the cash that they received in, but also cash that goes out for paying, for example, the suppliers or just regular bills on rent and so on. So everything that you see in this section is their operations. So it starts with the net income. It's one of the approaches to create a cash flow statement, and then make some adjustments. This is purely looking for a cash point of view. So depreciation, well, it's not really cash. Yes, it is part of the income statement, but it isn't cash. So it is identifying the transactions that are not cash and takes them out. Same goes for stock-based compensation. There hasn't been any cash paid, but that doesn't mean it's not an expense. So you can see that except for 2020, I'm not going to look into that too much as it's pretty much a COVID year. Outside of that, we have roughly 5-6 billion being generated by Nike. So 5 to 6 billion from their regular operations, and we can also adjust for the stock-based compensation. Then we can take a look at the investing activities. Did they actually acquire another company or not? Now, purchases of short-term investments, well, we already saw what those investments are. And there's the maturities of short-term investments. So actually the net of these two is, and we have sales. So probably if we take all of these three, that's the net change year over year. But we know that all of this is kind of quite close to cash. So even though it is part of the investing section, it's good to know it, but it's not something that we can make use of. Then we have additions to property, plant, and equipment. And this line, what I want to compare it oftentimes is with the depreciation. Because from an accounting point of view, if a company has certain equipment, it is being depreciated over 5, 10, 15 years, right? Depending on the accounting policy. At some point, that same equipment needs to be replaced. And if the company just replaces that equipment, then in theory, for a very large company, the depreciation would be equal to the addition. So what being replaced is just being replaced, and that's it. In most cases, the ones that are growing, you'll notice that this second part, the addition, the expenditure, the investing part, it goes to PPE will be higher than the depreciation. So let's take a look if that's the case for Nike. 2022, 650 against 750, so that's 100 million in excess. Then we have 744, so this is actually quite comparable. 2020, 721 compared to 1 billion, so that's 300 million, 400 million even, or 350. So I think we could say around 150 million more than the depreciation, at least for these couple of years. So it's quite clear that they invest more than they actually need to replace the equipment. Those are significant amounts. The reason why I mentioned this is at some point, if you're using this template, you know that there's this sales to capital ratio. And if you do that, so let's assume that we have a certain rate, this will pop out, reinvestment. And this is purely the reinvestment, not the part that is used to replace the existing assets, but the investment that's needed for further growth. So in this case, it would be somewhere around this 150 million based on the historical numbers, but there's more to that. And here you'll notice that if Nike's revenue grows by 2%, then this is 280 million. And your question might be, well, if we have the initial depreciation covered here in the operating income because we didn't make any adjustment, how this doesn't make sense. We see that historically this amount is additional reinvestment was 150 million or so, 200, but it wasn't this high. True, if we look solely through the lenses of the cash flow, that is correct. But if we take a look at their balance sheet, the inventory grew from 5.3 billion to 8.4 billion. The accounts receivable grew from 3.5 to 4.7 billion. Of course, we have some more positive effects on the other side as accounts payable also grew. But this is also capital that is being tied in. So everything that's in here, that is the reinvestment, it doesn't mean that is purely in property, plant, and equipment. It could be in inventory. It could be in accounts receivable that grows over time. It could be anything that the company, kind of depends on the management, but historically, this was the case. So it is a good estimate. It doesn't mean that it's perfect, and we will see. I'll try to share some more information on the forecast part in the last video, and that is more about making assumptions and give you a few tools that can be used along the way. But looking at the different, I'd say, parts of the cash flow statement, right? So the first one, we can see that Nike is generating positive cash flow from operations, even if we adjust for stock-based compensation. There is quite some, I wouldn't say there's any stability when it comes to inventory. I mean, these 2020, they spent quite a lot there, so it increased significantly. Then we have a decrease. I know this here is positive, but it's if they sell the inventory, they get cash in. It's kind of the opposite of, here it's also mentioned increase or decrease in inventories. And same goes for accounts. Okay, this one actually increased, cash increase. Okay, that's actually quite all right. Having good cash from operation is good. So normally, if you're looking at free cash flow, the formula is just take the investing part out, the capex part out of the operations. Let's take a look at the financing. So yeah, we saw the issuance of debt now to up to 9 billion. So that is something that we saw. This is of course, the proceeds from exercise stock options. So when the stock options are being used, they get some cash in and shares are being issued. And there's repurchase of common stock. So what we also saw, the number of shares outstanding did decrease over time. It's not regular purchases, so 3 billion, then 600 million, now 4. So can we search for something like that, like shares, so 62. I'll come back to this page. Purchase. I want to check if there's some program. So authorized number of shares. No differences. Yeah. Want to see if there's any plan? Okay, so here it is. So in June 2018, the board of directors approved a 4-year, 15 billion program. Yeah. So what this means is, of course, in the next 4 years as of June 2018, so it's actually, it's getting close to that, right? Actually, it's gone already, right? Yeah, that one is gone. So now this is the new plan. So the board of directors authorized a new 4-year, 18 billion program that will replace. So in the next 4 year, the Nike's management have the authorization to spend up to 18 billion to buy back their own shares. So that is not, hasn't started yet because this is as of 31st of May. So everything that we see here that doesn't include, is not part of the newly authorized amount. So we can expect a lot of buybacks. And here, there's some information such as this that you can already kind of have an idea of what the management will do with this excess cash. So I expect that Nike does buy back more shares in the future, and there's dividends. So every year they're generating, let's round it to 5 billion cash from operations. They need to spend, let's round it also to 1 billion. A bit less probably. So they have less than 5. So there's enough. Every year they're generating more than 2 times the amount that they'll pay as dividends. Except, of course, you see 2020 with COVID, they still managed to generate cash. So even in COVID times, they actually generated enough cash to cover the dividend without any additional raising. They did raise money, so again, nothing wrong with that. Maybe it's good to comment a little bit on the share buybacks. They're creating value for the existing shareholders if the share price is below the value of the share price, the fair value of the company. Because if that's not the case, if they're buying back shares that are overpriced, then they're destroying value because they're spending the money of the company to buy back an overpriced share. So that is something that we can. I'll just note it here. Again, use this additional info to add any type of comments that you have. So I'll note, check whether share buybacks are creating or destroying value. And what I'll note as well is repurchase. Here's what we see. So we could also, there was information that, so far, right, from the previous program that they had, they bought 77.4 million at $112 a share. So I'll note that down. $112 per share was paid. Today we saw it was at 97. So share price today is cheaper than what they paid for in the last 4 years. I'm not sure how the share price is moving. Maybe I can add the last 5 years. It should be at least good. So the return 85%. It's not bad. Yeah, the last 5 years, I think. Yeah, we saw actually it was in the last 4 years they had the program. So in this part, actually, since they had the authorization, the share price is up 26%, 27. What was the peak? 179. So since then it's down 50% almost. So it's very, if the company is overvalued, then it's very likely that the share buybacks maybe were not the best decision, but yeah, that's something yet to see. Now from this point on, of course, understanding the income statement, balance sheet, cash flow is important. You can take a look at, for example, the competitors for your company, for the company that you're valuing, to see if there's significant change when it comes to the pricing power maybe, or the income statement, the profitability. Like the balance sheet, I wouldn't focus too much because we're not trying to compare to see which one is better. Although you can, of course, do some ratios, some comparisons. I would more focus on the profitability. For example, how does what we saw for Nike, right? Accounts receivable to revenue. Well, we could see what we could do is we could divide the receivables by the revenue, multiply by 365, and that is the days. So on average, it takes them 35 days. It took them 35 days to the receivable outstanding, right? And then it's 36. We could do the same here for the inventories, the average amount of time that they keep inventory. So that's 93 days. So this is count receivable days. This is inventory days. Well, this is quite a lot. So they have enough inventory to sell products for 121 days. So this is again excess cash. And if you think of it that way, if the inventory increased in proportion with the cost of goods sold, right, by the, what was it, 23.4%, it would have been 6.5 billion. So that's, you have a difference of close to 2 billion of capital that would not have been tied in inventory. So something that's worth checking. So if I'm to invest in Nike, I would pay attention to definitely to accounts receivable, definitely to inventory. This is a little bit high, also based for the historical standards. I would also take a look at, for example, other competitors. Sometimes I think that sometimes they also have information about competitors. I thought they also have here, right? Oh yeah, competitors. Not sure whether all of these. Yes, some of these like Lululemon, it might be a good competitor. Adidas definitely might be a good company to compare. So it might make sense to, for example, check some of these ratios, how Nike compares to these companies, and that already gives an indication of the how well they operate, again, compared to each other, and maybe if there's some improvements. Because yeah, it's strange because inventory was never this high for Nike. 8.4 billion, it's above the average for the last 5 years. Let's take a look at the quarterly for the last couple of quarters. Maybe we notice that it's actually decreasing now. 6.7. It went up significantly. So I'm not sure. Same goes for the receivable. So this last quarter was really one that's a bit more tough for them so far. So there's still a lot to be checked, but it already gives me a feeling that they're not doing a great job when it comes to inventory and accounts receivable compared to how they performed, how they managed the business in the last years. But for the rest, it looks good. I mean, the debt, acceptable. Accounts payable, yeah, quite all right. I'll try to wrap this video here. I don't want to keep it that long. As you go through the company that you're valuing, again, note the lines that are significant for the business. And if you have questions, always first check the annual report. Maybe I'll try to go quickly through. For example, let's see at inventories if they have something mentioned, because it's a good example, right? Inventory balance, all finished goods. So this is all finished goods, but there isn't really more than that. Accrued liabilities. Long-term debt. Let's search for inventories. Maybe we'll find something that's... here's inventory. So majority... So this is also interesting. You see, inventories, we have a huge increase in North America. The rest is actually either flat or declined. Do we have the same for... Oh, we can't... yeah. Accounts receivable were quite high also last year, so maybe we need to go a couple of years back to make that comparison. No, but nothing really to... We make ongoing estimates related to the NRV of inventories. Yeah, this isn't really useful, inventory reserves. I mean, of course, they want to have enough inventory if the demand increases, but at the moment, it's a bit too high. And this NRV is basically if they expect that their products will be sold for less than what they actually what it costs them to make, then they have to reduce the amount that's on the balance sheet. But yeah, I'll wrap it here. If you have questions, of course, first check the annual report, then there's Google, and then of course there's the comment section. But try to find the answer on your own first, and because once you do that, not only that you know the answer for that company, you know where to find it also for the next one, and it's very likely that the same question will pop when you do another analysis. That would be all for now. Thank you for watching until the very end, and I'll see you in the next video.